So let's dive into companies. I mean, we're gonna probably talk about some companies, but again, if we stay to the first principle, what makes truly a great company in your perspective, and how should you detect it?
Well, I think in the long run, the company the returns we as shareholder are going to get are going to migrate towards the returns the company are creating on their capital. So the simple metric, I mean, either a return on equity, and if there's debt involved, return on capital employed. We can go in a bit more detail, but over time, even though if you pay a bit higher price for a company with a high return on capital, your outcome tends to be much more favorable. Over the long run, I mean, if the company has a return on its capital of 7-8%, I mean, that's probably what you're going to end up with as an investor. So but ideally, obviously, you would like to buy a high return company at a low price. But again, as Warren Buffett says, it's better to buy a wonderful company at a fair price than a fair company at a wonderful, quote unquote, price, right? And going back to first principles, but even on a return on equity basis, keep in mind that's just EPS, earnings per share divided by the book value. I mean, and you can have all these examples of how things can go astray. Take an industry like the Norwegian seismic industry. You had two companies for 25 years. TGS was a capital light one, and PGS owning all the vessels. I mean, in the end, the only thing that went up in PGS was the number of outstanding shares, right? So what happens then if it's earnings per share, so the number of top of the equation, becomes smaller and smaller, and you end up diluting a return on equity. So those are the one of the key metrics. You want to find companies that have a high return and incrementally are able to invest at those levels, ideally without too much leverage, but ideally being able to put a lot of that at work. But the key question is if a company, again, as we talked about having a calculator or saying a company has a high return on capital, I mean, that's not really an edge, right? So the key determinant, and the reason it's useful to study history is when does it tend to go wrong, right? Because if you think about it, it's like if you have a high return, it's like being in a mid-age as castle. Remember all the castles from the Middle Ages? And you have this moat around them. And thinking about it, if you do own that company or that castle, a lot of people will try to attack it, right? If you have 20% return on capital, every Peter, John, and Dick, and Harry is going to try to attack you, right? So you need to have some powers to defend yourself. And I think the framework one could easily apply and most could apply would be like Helmer's 7 powers, which tends to be like switching costs, network effects. At least look for one of those things, right? Is there a brand? Do they have a cornered resources? Or is there a processing power? One of those 6-7 called defense mechanisms around the castle to maintain the high return on the capital that you do have. And on that part, that's when it's more art than science, and it helps reading history to study how things went wrong in the past.
And I think, listening to you talking about moat, it reminds me of like this brilliant quote from Peter Thiel, this great investor that, all great companies that looks or effectively is a monopoly claim to not have it. And all the other companies who really don't have a moat claim to be a monopoly in order to stand out, right? Then we're back to psychology again, which makes this so fascinating that if you're a brilliant company, maybe it's in your interest not shout it out that much. Take your Googles, your Amazons. They don't really want that perspective on them, right?
No.
But if you look behind, it's like, okay, it's pretty close to something looking like a monopoly.
Yeah, and it's, you're touching, some of those companies, right? They are first of all, there are several companies wrapped into one company, which is one interesting aspect. But the more interesting thing is that many of these companies do look, on first sight, expensive. Let's do an extreme example. Amazon has always looked expensive, right? And in the meantime, they have created this enormous scale effect. And why is that? That's because they've spent a lot of R&D. So in those companies who decipher, is it cheap or not? I'd rather look at, do they have a high gross margin? Because that tells you, are the customers willing to pay for it? And by high, I mean kind of north of 40 to put a number on it. We're starting to talk those kind of gross margin numbers. it shows a willingness that the clients are, you have customers and clients willing to pay up. So rather looking at, is it expensive on PE, take Amazon for that matter, look at gross profit divided by total assets. And then you can decipher and really turn out that, so you don't want to punish companies that invest a lot in R&D, marketing for that matter, over their P&L, so they look expensive, but in reality they are creating shareholder value under the hood and building that moat of scale, or brand for that matter, in LVMH in France, for example, investing a heck of a lot in commercials, which we all have seen, right? Which has a very long lifespan, but it's taken over the P&L each year.